market bubble about to burst. The stock market seems unstoppable. Every few weeks, new records are broken. The S&P 500 continues climbing. The Nasdaq keeps reaching fresh highs, and millions of new investors believe the rally could last forever. But history has a habit of repeating itself, and according to Warren Buffett, the world's most successful investor, today's market may be sending a warning that too many people are ignoring. During Berkshire Hathaway's 2026 annual meeting, Buffett shared a simple but powerful observation. He said the stock market has become like a church with a casino attached. The church represents investing, carefully studying businesses, buying companies with strong fundamentals, and patiently holding them for years. The casino represents something completely different: speculation, chasing trends, buying because everyone else is buying, trying to get rich overnight. According to Buffett, more and more people are choosing the casino, and when speculation begins replacing investing, markets often become detached from reality. But is Buffett simply being cautious? Or does history support his concerns? To answer that question, we need to look at the numbers. One of Buffett's favorite ways to measure whether the stock market is expensive is something investors call the Buffett indicator. It compares the total value of the US stock market to the country's gross domestic product, or GDP. Think of it as comparing the price of the entire market to the size of the economy supporting it. When stock prices grow much faster than the economy itself, valuations become stretched. Historically, Buffett has warned that when this indicator approaches 200%, investors may be playing with fire. Recent market data places the indicator above that level, suggesting that US equities are trading at historically expensive valuations. Another important measure tells a similar story. The Shiller-Cape ratio looks beyond short-term profits by comparing stock prices with inflation-adjusted earnings over the previous 10 years. Unlike traditional valuation metrics, it smooths out economic cycles and provides a broader perspective. Today, that ratio is hovering near levels rarely seen in modern financial history. The last time valuations remained this elevated, the world was living through one of the greatest investment manias ever recorded: the dot-com bubble. During the late 1990s, investors believed the internet would change everything. In many ways, they were right, but excitement became irrational. Companies with little revenue, no profits, and sometimes not even finished products, were suddenly worth billions of dollars. People believed prices could only go higher, until they didn't. When reality finally arrived, trillions of dollars disappeared. Hundreds of technology companies vanished forever. Many investors lost their life savings. But something remarkable happened after the crash. Not every company failed. Businesses with real innovation, strong leadership, healthy finances, and sustainable business models survived. Companies like Apple, Microsoft, and Amazon endured the volatility and eventually became some of the most valuable businesses in history. The lesson wasn't that investing had failed. The lesson was that speculation eventually runs out of fuel. Real businesses survive. Speculation rarely does. That is exactly why Buffett continues repeating the same message decade after decade. Ignore the noise. Ignore the hype. Focus on quality. Own businesses, not lottery tickets. Of course, none of this guarantees that a market crash is around the corner. No investor, not even Warren Buffett, can consistently predict when markets will peak. History shows that expensive markets can remain expensive longer than many expect. Prices may continue rising for months or even years. But history also reminds us that periods of extreme optimism are often followed by periods of painful corrections. The greatest mistake investors make isn't buying during uncertain times, it's forgetting that risk still exists when everyone feels confident. So what should investors learn from Buffett's latest warning? Perhaps the answer isn't to fear the market, it's to respect it. Because successful investing has never been about chasing excitement. It's about discipline, patience, and understanding that wealth is usually built over decades, not days. Whether this market continues climbing or faces a major correction, one thing has remained true throughout history. Companies with strong fundamentals have consistently outperformed speculation over the long run. And maybe that is the real message behind Warren Buffett's warning, not that the market is doomed, but that investors should remember the difference between investing and gambling.